Happy Monday. This is Rob McDougall, investment strategist with Zhang Financial, here with the weekly economic update. Today is August 29th. So we're going to go through, as we always do, a review of all the economic data that was important last week, talk about how the markets responded to that data, and then go through some of the economic data that is expected this week. So for last week, it was a very mixed bag in terms of economic data, and the market did not respond well. The first data point we got was U.S. new home sales, and it was just plain ugly in a word. 511,000 total new homes in July. That was way down from the month before and far off the peak that we saw in December. So it is pretty clear that both increasing long-term interest rates as well as slowing economic growth here in the United States is impacting residential real estate. So if you were looking to sell your real estate in the last 6 months, you may have missed your window. In terms of initial claims, the weekly jobs claim number, that was good, and it looks relatively stable. It was 243,000 reported last week. I would say over the last 5 weeks, the numbers have been solid, probably better than expected. The big one last week, and this was the encouraging one. We've talked so much about inflation. Last week was the PCE, so that's the Personal Consumption Expenditure Indicator, and that is the one the Federal Reserve has always pointed to as their go-to in terms of gauging inflation. So the expectation was it was going to drop from a month-over-month increase the month before of a positive 1% down to a 0.1%. It actually came in at a negative 5% month-over-month. So that is very encouraging. On a year-over-year basis, that came in at 6.3%. But that's down from 6.8% the month before. So the July PCE number, very strong, corroborates what we saw on the CPI index 2 weeks ago. Now, there's also hope, we think, for inflation to look pretty good for the month of August as well. If you take a look at what we believe is a big driver to inflation, which is oil prices, going through to gasoline prices at the pump, continue to go down through the month of August. So that is a good backdrop, we believe, for the inflation data that we'll see next month. Last week, the economic data points, as I mentioned, were mixed. One thing that was decidedly not mixed, it was a commentary from Fed Chairman Jerome Powell at the Jackson Hole Summit on Friday. This really set the markets off. So the markets were struggling a bit during the week, had a tough Monday, and struggled back a little bit Tuesday, Wednesday, Thursday. On Friday, Chairman Powell at Jackson Hole had some pretty stark comments in terms of the Fed's approach and thoughts on the economy. In particular, Powell mentioned the Fed will not be shifting to a rate cut cycle anytime soon. And on the contrary, Powell pointed out the need to take rates into restrictive territory and hold them at higher levels for some time until the Fed is confident inflation is getting back down to the FOMC's goal of 2%. Probably the worst commentary that set people off was the Fed chair said, this will also bring some pain to households and businesses, and that the historical record cautions strongly against prematurely loosening policy. So that threw any cold water on potential dovish action by the Federal Reserve in the coming months. So as a result, that really did hit the equity markets last week. The S&P 500 was down about 4% for the week. And the way that breaks out, value did hold up better last week, down 2.9%. U.S. growth stocks were down 4.9%. And small cap held up better than large cap last week, small cap being down about 3.2%, large cap being down 4.1%. Now, we keep bringing this up because our portfolios are biased towards value, towards small cap. That has been a very good thing this year, at least in relative terms. So on a year-to-date basis, value stocks in the U.S. down 3.2%, growth stocks as of Friday down 27% year-to-date. Last thing to mention in terms of returns last week, very mixed in terms of bonds, and a little bit surprisingly, U.S. long government bonds held up the best, up 30 basis points. U.S. aggregate bond index, more comprehensive, lower duration, was down nearly 40 basis points. So in terms of this coming week and the calendar, we'll go through those quickly. Consumer confidence. Now, we already had the University of Michigan Consumer Sentiment Index a week and a half ago. That was solidly positive, better than expected. So the U.S. metric for that, the Consumer Confidence Index, will be coming out on Tuesday. It's expected to move up to 98.0 off a slightly lower base from the month before. Another very key one this week will be on Thursday, the ISM Purchasing Managers PMI Index. We follow this very closely. It's our go-to in terms of U.S. manufacturing trends. Trend has not been good. It's definitely been down. February looked like the peak so far this year. It keeps going down. Now, last month it hit 52.8. It's expected to further drop to 51.8. Many of you that I've talked to about this index will recall it's scaled at 50, so anything below 50 suggests contraction in the economy. Anything above 50 is expansion. The higher the better, lower the worse. So we'll see how that comes out. The expectations are for another modest drop, very close to the 50% range. That'll be on Thursday. Last one for the week, non-farm payrolls. Friday release is expected to be strong, well down from last month. Last month was abnormally high. We're not quite sure how it came out this high. It was 528,000 new jobs. The expectation for this month will be 310,000. So that is it in terms of our economic update. As always, we just mentioned that we follow these things very closely. We don't necessarily move portfolios around as a result of what we're seeing in the economy or in the marketplace. As always, we just tell our clients to remain disciplined, diversified, and balanced throughout time, and you'll do well. So, thank you for your time. Appreciate it. Hope to see you next week.